Good afternoon. I'm happy to be here presenting again on APAC deal activity. So I'm Clement Ma. I lead our company information services business in APAC, and I'm joined again by Josh Mintz, who leads our APAC desktop business. We're also happy to have Charles Silva presenting with us today. Charles joined us through S&P's merger with IHS Markit and leads the software solutions commercial strategy in APAC. So the last few times we gave this presentation, headwinds were always the big underlying theme. First, it was the trade war and geopolitics, and then it was the pandemic. And now, starting from the left of this page, we're running up against the biggest wave of headwinds yet. On the one hand, in some parts of APAC, we're starting to see the positive effects coming out of the pandemic. Countries have learned to live with COVID, and travel and spending are coming back up. On the other hand, China's approach to COVID continues to have an economic impact that ripples across supply chains around the world. And combine that with the regulatory uncertainty around tech companies, that has played into a lot of market volatility. Of course, the war in Ukraine has had a predictable impact as well. And all these forces have built off the loose monetary policy, leading to the inflationary environment we're in now, where we sit at the brink of recession as central banks quickly tighten. Moving to the right in terms of impact, of course, we're all asking when financial markets will bottom. There are also high expectations that corporate earnings will be coming down soon. Longer term, these forces may shift some of those big macro trends, like acceleration of the global decoupling that started with the trade war, also the pressures around energy security that now goes head to head with ESG and climate change efforts. And so as we dive into the presentation, it's about the impact on M&A and IPO activity. Does it derail private markets momentum? Are companies continuing to invest in technology? We have a lot of data slides to go through, so I may cover some of these fairly quickly. This picture is straightforward and should be very familiar to all. This is an index stock price chart since the start of 2021. The colored lines here represent some APAC color schemes that we'll see through the course of the presentation. Dark blue represents China, light blue Japan, India in yellow, Australia in brown, Singapore in purple, and Hong Kong in pink. And then on this page, we have the S&P 500 represented in the orange line. We can see the market run up, especially the S&P, to the peak near the start of 2022. And then, of course, we know what happens. On the table to the right, we can see the relative price movements across different time periods, with 2022 year to date reflected in the middle column. And we can see there S&P hovering at near bear market levels. On a year-to-date basis, the Singapore Straits Times Index has been the best performing market. And then if you look at the other two time periods, you see that India has been the best performing market over a 3-year time period and from the start of 2021. So I think a lot of the media commentary out there is that the analyst community is being too slow to react around this potential recession. And so this chart looks at the breakdown of broker estimate recommendations over time, with green being buy recommendations and red being sell recommendations. What is surprising is that the number of buy recommendations has continued to climb upwards since the start of 2017, in some cases to its highest point right now in mid-2022. One dynamic playing out in this chart, especially as we talk about China, is the pullback of stock prices and the relative underperformance over the last few years that has led to more Chinese stocks being considered value opportunities. For example, JD.com 3 years ago had 14 holds and 15 buy recommendations, and it now has 2 holds and 29 buys. There's NIO, the China electric vehicle maker. It has seen buy recommendations go from 4 to 15, and that's over a time period where its share price has declined by 70%. So certainly with this covered universe, there are a lot of buy recommendations and no signs yet of that trend reversing. Along the same lines, are analysts starting to revise their earnings forecast down? So these charts look at the analyst revisions over the last 3-month period, with red representing aggregate downward revisions and green for upward revisions. The left chart looks at APAC industries in aggregate, and the right chart looks at global regions. So we are starting to see a trend of downward revisions outweigh the upward revisions, although at this point, there are some views that this should be further along. From a regional standpoint on the right-hand side, APAC is further along on downward revisions. And in the blue box there, we've specifically called out China, which is more negative as you'd expect given the economic impacts of the COVID-related shutdowns in recent months. Also on the industry segment level, China real estate, which is also boxed there in blue on the left chart, has been a sector with many more negatives than positives. On the inverse side though, as expected, the energy sector has been weighted towards more upward revisions. Shifting gears to focus on the sentiment of companies themselves, this chart looks at earnings, company earnings calls. And to be clear, this is based on the date of the earnings event, not the fiscal quarter. So using S&P's textual data analytics dataset, we looked at the universe of companies hosting earnings calls based on the average net positivity and how that trended over time. The top chart here shows the trend in net positivity over time. And as we'd expect, looking back over the last 3 years, the lowest positivity scores occurred in Q2 2020 as the pandemic was starting to explode worldwide. What we've now seen is that across all markets, we are back to the pre-pandemic levels of net positivity scores, with both China in dark blue and the S&P 500 in orange leading the way. In the last quarter, we started to have some positivity scores trending down, but for the most part, the company sentiments and earnings calls haven't yet captured the pessimism in the market. So we'll be looking closely at this current earnings season to see how much further we trend down. We've also captured here the top and bottom 3 sectors by sentiment, but in the interest of time, we'll move on, and you can request a copy of the presentation to have this slide for further reference. While we're on the topic of earnings transcript, here's a slide that covers filings and investment research. This slide counts the instances of documents, transcripts, and investment research reports that reference ESG. And of course, it's not completely surprising given the market forces around ESG, but it still looks quite remarkable with the explosive growth of companies that are now referencing ESG in their reporting and narratives. To wrap up the perspective on equity markets, this slide looks at the aggregate of active fund managers with a global investment mandate and how their portfolio allocations to APAC have trended. The chart on the left shows the aggregate portfolio allocation percentages, again using those same color-coded lines. Of course, this chart doesn't tell the story between active management versus market movement. So the chart on the right reflects an estimate of the change that is due to active portfolio decisions. The interesting story here is that we have seen a steady downtrend of APAC and global portfolio allocations, although as of Q1 this year, we have started to see that trend reverse. So changing lanes, how has this backdrop affected M&A activity? Looking at global activity, 2021 was an absolute record year, and it's pretty impossible for us to match that in 2022. Having said that, despite the macro backdrop, we are trending towards still a strong year compared to the previous year levels. The chart on the left shows deal counts by target subregion. North America is in dark gray, EMEA is in red, APAC is in orange, and LATAM is in light gray. And the chart on the right is based on aggregate deal values. The story is pretty consistent across both charts. Annualizing the first half of 2022, we'd have the second best year on record in terms of announced deals. And that applies to APAC as well, in specifically those orange slices. The reality is offsetting the tighter monetary environment and the inflationary and economic pressures, the reduced valuations combined with continuing trends around private markets and technology has continued to help support healthy overall deal activity. These next 2 slides are a different way of looking at inbound and outbound M&A flows into APAC. And this is over an 18-month period from 2021 through the first half 2022. This slide focuses on deal values, while the next slide focuses on deal counts. On the left, you see flows from buyers based in APAC investing outside of APAC. And then on the right, you see flows from buyers outside of APAC into the APAC region. A few years ago, when we were talking about the gray rhinos in China, this page would have looked drastically different, with China as a thick navy blue wave flowing into North America and EMEA. Some of the interesting highlights now from this page, we see the big purple wave from Singapore to North America. That actually includes the $48 billion reverse merger of Grab into a SPAC. And Josh will cover that more later as we talk about SPAC in the IPO sections. And on the inbound side, there's the big flow of investment from North America into Australia, which is captured there in the gray wave. And that included KKR's $21 billion acquisition of Ramsay Health Care. So this is the same picture, but in terms of deal counts and not deal values. I think the biggest takeaway from this slide are the number of inbound transactions flowing into India, which is captured there in that largest yellow bar on the right-hand side. There's been a lot of private equity activity, also with interest in sectors led by technology, renewables, infrastructure, and also real estate. The next few slides here slice the M&A data with a bit more detail. And to be clear and distinguish it from the previous two slides, these reflect both domestic and cross-border activity. The role of mega deals has been a global headline over the past year, and this slide here captures the relevance of mega deals in APAC. The small charts at the top group deal activity by transaction sizes. And you can see with the two top left charts that are greater than 10 billion and 5 billion, that combined, we do see a steady flow of activity from large deals that contribute to overall deal volume. If you look at the largest deal so far this year in 2022 on the table on the bottom right, I mentioned Ramsay Health Care earlier, which was the second largest deal so far this year. The largest deal this year so far is HDFC's acquisition of Housing Development Finance Corporation for 60 billion, announced in April, which is the biggest ever M&A deal in India. This slide drills into specific industry sectors that have been the most growth, that's seen the most growth in deal volume year over year for the first half 2022. The top three sectors being semiconductors in gray bars, commodity and chemicals in red bars, and then biotech in orange. And you can really visually see that rising trend in the bars. On the charts to the right, we see the same industries with their breakdowns by the target country colors. And we can see that China in dark blue has dominated most of the activity in the top three sectors. And so lastly, taking this data one step further, this slide drills specifically into rounds of funding transactions into emerging themes that we call topic tags. Last year, we launched an additional layer of company associations called topic tags that help us search and identify companies by emerging themes and business exposures. And this goes well beyond traditional industry classifications. We launched with a universe of 200 tags that will continue to expand. And most recently, we worked closely with a healthcare-related client on expansion of therapeutic topic tags. And we can see some of those captured in these purple bars to the left with oncology and chronic diseases. So focusing on the charts on the page, on the left, we see the topic tags that have received the most funding transactions from the start of 2021 through the first half of 2022. And then on the right-hand side, we see the topic tags that have seen the most growth year over year for the first half, and that's based on a net increase in funding transactions. So we don't need to go through the details here, but certainly there's a lot of areas and themes that we know and recognize are shaping corporate investments and growth right now. With that, I'll hand it over to Charles to dive into private markets.
Thanks, Clement. It's great to be here. My name is Charles Silva. I'm based in Hong Kong, and I oversee the commercial strategy for S&P Global's software solutions business in the region. In this section, we're exclusively going to be talking about the private markets, deal flow, fundraising, and investment trends. So while mega deals in the region seem to be fairly robust, deal activity globally is trending downwards compared to last year. But keep in mind, we're only halfway through the year on the far right-hand side, as you can see. So while APAC might not eclipse last year's total value of deals, it looks like it should end the year above the 5-year average. Within APAC, Japan and Australia have had a pretty active first half of 2022, which has made up for some of China's total deal value declines. Now let's take a look at fundraising. This slide depicts PE at the top and VC at the bottom. These two stacked bar charts represent fundraising from regional GPs and fundraising from American and rest of world GPs, all of whom are raising dedicated APAC funds. For comparison purposes, we've overlaid all global PE and VC fundraising across all regions as the red line into their respective charts. Looking at PE APAC focus funds versus the global red line, we see APAC trending downward over the last 4 quarters, with China GPs seeing the biggest fundraising declines. While the VC side is smaller when viewed on the same scale as PE fundraising, we observed a similar trend with Asia-focused funds down in 2022, though there was an uptick from Q1 to Q2. However, recent headlines from Sequoia announcing it was raising several funds that would focus across Southeast Asia and India bring some positive news to the region. Now let's take a look at private market benchmark returns, where we'll compare private equity vintage years on the left-hand side of each chart with venture capital on the right-hand side. We also have IRRs at the top and net multiples on the bottom. Everything that you see on screen here is available as part of your subscription to CapIQ Pro, which gives clients access to Preqin's benchmarks. Over the last 20 years, private equity has been one of the most lucrative asset classes, returning on average 10.5% per year. That said, over the last 9 or 10 years, that tide has shifted and venture capital has outperformed private equity. This is true across geographies, but it's even more pronounced in Asia Pacific. However, it's also worth mentioning that the standard deviation of returns in APAC is also higher at 26%, compared with about 15% in Europe and 19% in North America. The same is true of multiples at the bottom, with VC outshining private equity over most vintages, particularly in the APAC region. Now let's take a look at what LPs are looking for. This depiction comes from our Preqin Premium dataset and represents LP investment plans. We have an interesting sunburst graphic on the left. Starting with the center of the sunburst, or the donut, let's look at that dark green portion. These are LPs who intend to make commitments over the coming 12 months. The light green are LPs who are just considering deploying capital into private markets in the next year. As you expand out within the donut, we can see that of those that intend to invest in private markets in the coming 12 months, about 40% of LPs intend to increase their private market exposure to APAC, which is that bright orange slice on the left. And the furthest outward edge of that tasty donut shows us how they intend to do that. The majority of LPs plan to gain APAC exposure through global vehicles, 30% through APAC managers and about 20% through emerging managers. In terms of industries of interest, information technology is the biggest industry of interest for LPs, followed by healthcare, not too far behind. And then other industries of interest are consumer discretionary, industrials, and then a three-way tie between media, energy, and telecoms. We also see the top 5 verticals being markets involving a group of companies that cut across multiple industries. We weren't surprised to see fintech or investech on there, given the products and unique data that S&P Global provides to its global clientele. On this next slide, we take a closer look at a portion of fintech or investech deals. This data on screen only depicts deals with disclosed deal values. It certainly isn't an exhaustive list of all the software deals related to private markets. For this slide, we've used a combination of topic tags, Crunchbase categories, industry classifications, and business description keyword searches to identify the universe. What's interesting about this slide is the growing number of deals that are targeting private market participants. As LPs continue to commit capital to private markets and AUM of GPs continues its rise, it's not surprising that the number of software providers entering this space has really grown over the last few years across geographies. The data deluge experienced by both GPs and LPs is real, and more players are entering the space to try to create efficiencies for LPs and GPs. Some of the big names on here include State Street's acquisition of Charles River, NASDAQ acquiring eVestment, the formation of iCapital Network and Moonfair, and of course, S&P Global's acquisition of IHS Markit, which gives S&P Global access to IHS Markit's full suite of tools being used across the private markets landscape. One comment that I'll make is that while EMEA and North America seem hyper-focused on solving global LP and GP challenges, APAC's regional players are more focused on solving niches that LPs and GPs are facing, such as venture capital workflow, accounting, and trading platforms. So where are GPs and LPs on this road to digital transformation? We conducted a survey across about 350 institutions globally and found that most LPs and GPs in APAC have already started down that path to technical modernization and digitization. That said, compared to other geographies, LPs and GPs in APAC are lagging most others in terms of assessing software in the market and deploying such transformational solutions. We collaborated with FEMA, who conducted a survey on our behalf, to come up with the following results. And so what makes it so hard for these LPs and GPs to embrace technology when it's going to improve their efficiency and give them more time to focus on their investments? The majority of firms said that it was getting that internal buy-in from key stakeholders, aligning interests, convincing the teams that the technology would improve their organizations, and demonstrating value during and post software implementation so that the LP or GP is maximizing their return on that investment in that technology. Now, most of you may know S&P for its flagship product, Capital IQ Pro, but after its acquisition of IHS Markit, S&P now also powers unique software and data solutions that are used by nearly 1,000 GPs and LPs in the market. iLevel is our best-in-class product used by both GPs and LPs to collect and standardize investment information and give investors easy access to the dashboards of data that they need. The key is we help clients navigate complexity, gain insight into their portfolios, work smarter, and keep pace with internal and external demands, as well as market and regulatory changes. The impact iLevel has on an organization is substantial, and our client feedback speaks for itself. Clients experience gains in productivity, efficiency, and a significant return on their investment with portfolio managers, investor relations, finance, and members of the C-suite spending more time analyzing their portfolio's data and less time collecting and normalizing it. With all those efficiency gains, by modernizing and digitizing the investment lifecycle, GPs can spend more time assessing their exit strategy options. So let's pivot to the results of our survey to see what that looks like. Focusing on the top left chart, we can see that over the next 12 months, 91% of APAC GPs believe they will likely exit at least one portfolio company or private asset in their portfolio, which is certainly higher than any other of the other regions, as you can see across the other charts. What's also fascinating is the percentage of APAC GPs who believe those exits will occur via an IPO. With that, I'll turn things over to Josh, who will dive deeper into the IPO dynamic.
Thank you, Charles. Hi, everyone. My name is Joshua Mintz, and I am the desktop lead for Asia Pacific based here in Hong Kong. Jumping into our IPO perspective, here we have global IPO and new market listing trends at the top of the slide and our APAC focus markets at the bottom of the slide. The left-hand side of the page represents deal counts, and the right-hand side of the page represents aggregate transaction values. And we're using the same color schemes that we've been utilizing throughout the presentation. What's immediately visible as we look at the top left region chart is a large pullback in the number of deals we've seen compared to 2021. And this is also represented in the aggregate deal value chart on the right, comparing the enormous haul that we saw in 2021. There are bright spots here. We take a step back for a moment. The first is that APAC domiciled companies have led the way, both in issuance in the first half of 2022 and aggregate deal value, with 65 billion raised during that time period. The second is that if we look to the pre-pandemic period of 2019 and prior on a deal value basis, APAC as a whole is actually tracking ahead of those periods. And if we shift our attention to the bottom charts of our 6 core markets, we can see which markets are driving these figures within APAC. Not surprisingly, The majority of this has come from China, but throughout all 6 of these core markets, we're still seeing a large pullback from the pandemic years. But looking at this from the firm's location is only part of the story. If we jump to the next slide, here we depict the top global exchanges that have captured the most IPO issuance. The dark colored spheres represent the first half 2022 completed listings, and the light colored spheres represent full year 2021 listings. The size of the sphere represents the aggregate transaction value, and the exchanges have been ordered by the top ranking first half 2022 by aggregate issuance value. Based upon the last slide, it should come as no surprise that the Shanghai in light gray and the Shenzhen exchange in dark gray capture the most capital raises during this time period at 23.4 billion and 17.7 billion respectively. But what is quite interesting is the Korean Stock Exchange in green ranking in 4th during this time period. However, if we jump deeper into the data, we can see that this is largely driven off the blockbuster IPO of LG Energy Solutions at 10.7 billion. The dearth of issuance for North American companies from the previous slide carries over here, and we can see that NASDAQ has captured only 12 billion during this period, with the New York Stock Exchange falling even lower to 4 billion, And so looking towards the Hong Kong Stock Exchange, we're actually seeing a lower amount here on the Hong Kong Stock Exchange compared for overall Hong Kong domiciled companies. And this is primarily due to a subsidiary of China National Offshore Corporation listing in Shanghai. But issuance is only part of the story for these companies seeking capital and the financial industry that services this process. Investors of these IPOs are most interested in performance. And if we move to the next slide, here we beautifully depict IPO performance for deals closed from the start of January 2021 through June 30th of this year. The size of the bubbles represents the IPO size, and the height represents the performance for the first half of the year ending June 30th. And these have been distributed horizontally by their close dates. And so looking at this distribution, there are a few takeaways that surface quite quickly. The first is that many of the APAC IPOs from 2021 have performed quite well against their global peers, including the large deals of China Three Gorges Power and Hyundai Heavy Industries that both returned over 135% during that period. The second is that if we look towards LATAM, we see that these are underperforming against their global peers, with many trading at below their IPO price. And the third is that for 2022 IPOs, we still have Asia Pacific leading the pack in terms of performance, but that has been pared down from the returns that we saw for 2021 IPOs. Though this may be more of a product of the current environment or just overall runtime. And so, as we've seen from the previous slides, China has been leading the way in the APAC market. So as we move on to the next slide, here we focus specifically on Chinese IPOs. The top at the top left is for reference and is consistent with our previous slides. As we look to the chart at the top right of the table, we can see the total number of Chinese companies listed on major US exchanges at 226. And of these, our key developments database shows that 70 have made announcements about possible delistings. While this would be unfortunate for the US exchanges and the international investors that utilize them, it could be a boon for domestic exchanges as these companies return home to list. And so shifting our view to the chart at the bottom of the slide, we can see the distribution of Chinese IPOs and new market listings. The height of the circles represents the number of transactions closed in a given industry, and the size represents the aggregate deal value. And so the main takeaways here, as we look at the right-hand side of the slide for 2022, are that the majority of IPOs conducted in China have been in the information technology and industrial industries. And so as we move to our next slide, no presentation about IPO deal flow would be complete without discussing SPACs, especially as the Hong Kong Stock Exchange and Singapore Stock Exchange have moved to recently allow these listings. And so starting on the left-hand side of the slide, we see global issuance of SPACs through the first half of the year. Clearly, we're not tracking to the equivalent of 2021 like most deal types, but we're still at elevated levels compared to prior years, to 2020. And so when we look towards the aggregate amount raised chart in the middle of the page, we're not seeing nearly the same level of capital raised before, indicating in general smaller deal sizes. And so this reduction could be attributed to how unsuccessful these SPACs actually are in executing an acquisition. And so the success rates on the right-hand side of the page represents by IPO vintage year, which of these SPACs have successfully closed a deal. And we've chosen to exclude any announced deals, as many of these actually fail to come to fruition for SPACs. And so when we look at the most recent vintages, we can see the low overall success rates for years 2020 and forward. And so overall, SPACs continue to be a component of the IPO landscape, but to what degree will become more apparent as time passes. But what is quite evident as time has passed is the continued growth of APAC located unicorns with post-money valuations greater than $1 billion USD. And so looking at the chart at the top left of the page, we can see newly minted IPOs over the last several years. And for 2022, we can see that the majority of these have come from India. Touching on the chart at the bottom left of the page, this shows the distribution of industries for these unicorns. And the majority of these have come from information technology in the light blue and consumer discretionary in the dark blue. And so lastly, in the chart on the right-hand side of the page, we have the distribution of unicorns that have continued to receive funding after achieving their unicorn status. And so here we're using primary industry, which is a deeper level of industry classification, where application software unicorns in the cobalt blue have led the pack for additional funding. And so these unicorns will certainly power the future IPO pipeline, but what about the more immediate one? And so as we move to the next slide and wrapping up as we look and think about the outlook on the IPO landscape, this slide looks at our key development data for illustrative purposes. This focuses on the group of companies since January 1st, 2021 that have been reported or been covered in the media on planning IPOs. And so in each of these, we see a few things. The green shaded area represents these companies that have gone on to complete their IPOs. And if you look slightly below that with a light yellow, these are the companies that have gone on and outright communicated that they're no longer planning to IPO. And in the faint light green, we have those companies that have come out and announced they're reviving their plans for IPOs, like the one that we call out in APAC for Thai Beverage. But it's such a small number of companies that you can really barely see it on the chart. And so I think the overall takeaways as we look at this slide are quite expected as we consider the market headwinds. IPO plans are on a steady downtrend through the first half of this year. Plans for canceled or delayed IPOs are rising, although it's a proportionally small amount in the overall IPO landscape. And this is probably because companies in general aren't very vocal about this. And this is really consistent with the trends that we've seen for the last couple of years when we look at this on a deal count basis. And that is that APAC still has the largest prospects for IPOs, but both APAC and Europe, the news there has trended more downward sharply lately than that compared to North America. And within North America, over the last several years, even though the counts have generally been lower, the market has still led the way with marquee tech IPOs. And so with the current market appetite around tech stocks, at this point, we're not really seeing these high-profile deals active in the pipeline. Case in point would be Reddit here in the call-out. And so as we conclude our presentation, it seems each year we give this, we operate in a more and more complex environment. The pandemic continues to ebb and flow across the world, and varying regional approaches factor into the overall environment. Inflation, talk of recession make frequent headlines, and major market indices are down year to date. The war in Ukraine brought about rapid decoupling and a new examination on how we look at energy and food security, further complicating efforts around the climate. All of these have impacted deal activity downward, but despite this, deals continue to be executed. bright spot in many of our slides has been technology, and the increasing investments into tech that services the private markets is something that we're looking forward to powering the markets of the future. Thank you for your time, and we hope you enjoyed the presentation. I'll now invite Clement and Charles back for questions.
All right, thanks, Josh. So it looks like we do have some questions from the audience. The first one here, are there actual Chinese delistings from the US yet? What is your latest outlook on how this will play out? Josh, this was in your section. Do you want to take this one?
Yeah, sure, Clem. I can grab this one. And I think there's important clarification here to have about the key development delistings that we have here is this question appears to be directed specifically at the Holding Foreign Companies Accountable Act. And these delisting notifications also would include any companies that may not be meeting listing requirements, for instance, not meeting the minimum to be listed on the NASDAQ. But turning specifically to the Holding Foreign Companies Accountables Act, those delistings won't be put into effect until 2024. So there still actually is quite a bit of time to hopefully reach a resolution on this. And so there have been some positive headlines over the past couple months. And so I'm hoping that, a positive outcome will be reached here and that these companies continue to list in the US to give international investors access to them.
Great, thanks, Josh. The second question, I'm surprised that the APAC is that far behind when it comes to embracing private markets technology as compared to Europe and North America. Why do you think that's the case? Charles, I think this one's for you, right?
Yeah, I'll take that one on. Good question. I can only speculate, but let me share a few thoughts. Perhaps a sweeping generalization, but I think there are new investors in APAC, both wealth owners and funds. And as a result, they're trying to create a more efficient investment office from the start. I think that leads them to scrutinizing their operating models perhaps a bit more, making more calculated decisions about their software providers and data processing models. And I guess I'd also add, I think there's some segments within APAC, be it sovereign wealth funds, superannuation funds, or Japanese banks, that have multiple layers of governance and a broader swath of decision makers who sit in different offices or even different countries. And that slows decision making down when it comes to aligning on the best operating model to start and then selecting a best-in-class service provider to achieve that target model. So I think those are a couple of reasons why APAC GPs and LPs have been a bit slower to adopt new technologies as compared to some of the other regions.
Great, thanks, Charles. All right, next question. Why do Asia companies report on ESG so much more than Europe, per your slide? And so I think that's a question for me, and that's a great question. We had the same thought ourselves. We all know that Europe is at the forefront and leading on ESG. So we actually did look at the data, and at this point, it's purely a matter of listed company numbers. APAC has over 30,000 listed companies, while EMEA has around 14,000. So there are a lot more companies to drive that growth number. But again, yeah, this was a great question. In this exercise, we don't actually look at the depth of ESG coverage within a given document, but that's something that we were thinking about and something that we'd absolutely look at incorporating the next time around. And so I think the next question is also for me as well. On the EPS downward revision side, it was only a small number of Chinese real estate companies. What other sectors declined the most to contribute to China's EPS downward revisions? And that's correct. Yeah, real estate wasn't the highest number, but it was the highest percentage of negative revisions at 80% of the analyst changes in that sector. So if I recall correctly, the biggest contributor to the China numbers were industrials, technology, and consumer discretionary. And those three sectors accounted for almost 50% of the China downward revisions. And I think we have time for just one last question. We're a bit over already. The dramatic rise of the Indian unicorns is interesting. Is there any highlight in terms of which sectors seem to be emerging more than others? Josh, do you want to take this one?
Sure thing, Clement. And so it doesn't come as too much of a big surprise here, but these are primarily being driven by the information technology and consumer discretionary sectors.
Okay, great. Thanks, Josh. And so with that, I think we can wrap up. For all the questions that we didn't get to today, we will certainly follow up with you offline. And thank you very much for attending our session, and we hope you enjoyed the presentation.